Hello, virtual investors. Back here today on Tuesday, the 21st here, February. Just wanted to give you guys live update. Last week, I gave updates on how the market was going, how I saw this spring surge coming, and I still see it happening here. But we do have headwinds right now, and I just want to go over those headwinds. And so I'm going to get into some details here, share my screen. As soon as I can find it here. Oops. Here we go. All right. So I want to get into this a little bit here. Altos Research, somebody I follow here, I think his name is Mike, does a fantastic job. And I wanted to go over some of the stuff he has going on here and with what's going on in the market. So I'm going to play this here if possible. And see if I can do this here. Oop. Should be able to hear this.
Rates impact the surprisingly resilient home buyers this spring. The interest on 30-year fixed mortgage today is approaching 7% again. Just a few weeks ago, we dropped under 6. Contract this week as new pendings. And that's perhaps the first sign. Buyers who have been active in the market already this year, maybe now they're saying, since rates jumped from 6 to 7%, maybe I'll wait to see if they fall back down before I lock in my payment.
Okay. So mortgage rates have crept up here, and they've crept up, into the 6.77 range, getting close to that 7% again. They were not as high as in September. We were up around 7.22 or 7.25%, but creeping back up and going in the wrong direction because, as I said last week, with those rates dropping to the middle fives, call it, you brought back about 1.5 million of those 3 million lost potential home buyers there. Now the rate's creeping back up. You're dropping off at least another 500,000 there. Now you're maybe down to 1 million of them, and maybe less. Maybe could be that three quarters of them are gone again. So this is where the rates is something we really got to keep our eye on because look, it's a big factor. It's a big factor with what's going on in the market, and it's a driver. It's a basic macro driver. The two drivers we got going on in real estate are record low inventory or near record low inventory. One, super important. And secondly, rates, because rates determine affordability and how much you can afford of a house, right? How much is your monthly payment that you can afford? So with that being said, rates are huge, and that's the biggest factor here. And that's why I follow Altos Research. I give just good weekly information on inventory and with what is going on in the markets, for sure, to say the least. Also want to get in here is the mortgage rates. So we are at 6.77 on average. 6.77 is is what we got as the national creeping the wrong way, right? This is definitely the wrong way. Not where we were here, but we're going that direction again, and I don't like it. We need to get back down here. Otherwise, we are going to have a little bit more of a correction. And right now, you don't want it to go so low that home prices keep going up, right? Because the home affordability index is already bad. It's already really low. People already can't afford the rents either. But remember this, as this rate goes up, rent cost will go up with it because rates going up make it more unaffordable, and potential home buyers drop out and become renters. They become tenants. So you're going to notice rental applications on a rise, mortgage applications on the decline. Okay, they go hand in hand here, the rates. So very important things to keep your eye on. Now, if we look at house, the Redfin's home buyer demand index is down slightly, right? Because I mean, the jobs report was solid that came out, but again, these jobs were, as I said before, lower income jobs. They're more tenants than they are home buyers. So let's just look over. This is February 17th. Some of them, again, some of the buyers are retreating back to the sidelines as mortgage rates ascend to 7%. 7%, which is why the home buyer demand index continues to fall. If it goes in the other direction, drops back in the fives, it will go up and we'll have this great surge in the spring. Do we anticipate this happening? We will see. We'll see how quickly it is, whether rates kind of stabilize, turn sideways for a while, or go down. I'd like to see them get into the fives. Fives are very affordable for people. Middle fives, if we can get to the upper fours, that would be tremendous. And get investor mortgages into the middle fives, then you're going to have a couple of different things. You're going to have more rentals available. One, you're going to also have more people able to buy homes and afford to live in a home, which is better than renting if you had a choice. Now, other things we have to keep an eye on are inflation, right? Because that's been going up and not going down like they want, still too high. And inflation affects home affordability, right? Job market affects home affordability. Retail sales affect home affordability because as prices of all these things go up between retail sales, between retail, between food, between gas, because gas is going back up, oil is going back up, natural gas is going back down, which is nice. But we really need to see, and again, secondarily on another note, in order for more housing to be built, because we have way too few homes being built right now to support the demand for homes. So with copper costing too much in electrical, plumbing materials costing too much, lumber costing too much, windows, doors, siding, all these different things costing too much, home builders are not going to build homes. And they're not going to build the affordable homes. We need housing affordability to be coming down, and we need materials to come down in order to build smaller houses, not the bigger houses that these builders have to build in order to make a profit. So they need to, the government, if they're going to do something, which I don't generally want them to do anything, they should incentivize builders to build. It's tax incentives, whatever kind of incentives you can give them. Tax incentives would be great to build, to sell, or even build to rent, because we're going to need both. We'll see. I don't have any faith in a government doing anything properly. Locally, some places will do it better than others will do it. But obviously, the housing market this past week is down a little bit with the mortgage rates going up. Now let's get into a Forbes article here. The housing market forecast for February. And again, we're the 20th, so we're most of the way through February, just a little over a week left. 21st, sorry. A little over a week left. The median existing home sales price was up 2.3%. So this tells me a couple of different things. You know, if you read all the bad banner this past summer, fall, and in the early winter about how bad this housing market was going to be, how everything was going to crash, real estate was going to crash, just like Reventure Capital. That's every video that guy puts out is just about a real estate crash, which is just not true. But fear, doom, and gloom sell. So putting that crap out there gets views. I'm trying to give you real data, which will hopefully help you. But the median sales price was up 2.3%. And when you consider, and again, it's year over year, I believe, in December compared to a year ago. Yes. So if you go back December a year ago, the rates were 2.75%, 3.25%. And now they're 6.75%. I guess at that point in December, they might have been 6.25%. So because of that, you would think housing prices would be down. Nope. There's such low inventory. There's still pent-up demand. And this number is telling me that 2.3%. In fact, we're up that nationally. And I know in the Sun Belt, the prices already have gone up. Put Phoenix aside, the prices have been going up. So that tells me there's a lot of demand. And for H drop, this number will go to 4, 5, 6%, and even more. Some markets will be over 10. Some markets, it'll be 10 down. It just depends on where you are. Those markets, we talked about the Silicon Valley markets. Those are the ones that are going to continue to be hit. And the affordable housing markets are where the market will ascend and go to, because people are going to go to more affordable living, more affordable cost of living. And another factor we have, and people ask why all the time, why is inventory so low? Well, one real basic reason for it. Most, and I believe it's 85%, and I'm not sure if I have that article up on here. I don't believe I do. 85% of mortgages right now are 6% or below. So they're below what the costs are now. And when you think about it, probably 55% are under 4.5%. So those people have the 2s and into the 3s. Like me, I'm a 3% mortgage. Why would I sell? Unless I absolutely have to, because if I sell my house on my 3% mortgage, then go buy something else and I'm paying 6.75%, that more than doubles my payment. So why would I sell? Again, this is why you're seeing no inventory. This is why you're seeing numbers continue to go down. And if we go to, here we go. Let's play this a little bit more, because he talks about that, right? He's going to talk
slightly
about
fewer homes take offers and go into contract as a result. And we can see that maybe that first data point in the pendings, this it in the traditional channels. The data we cover here in these Altos videos are, I'm the founder of Altos, fewer than they were last week. We track pendings are 6%. Here we go. As I mentioned, new pendings are 6% fewer than they were last week.
And that is because of the rate increase, right? Once the rates increase, pendings went down. Makes so much sense. I mean, this is really simple. I mean, it's all about the housing affordability. I'm going to stop talking and let him get into it.
We tracked 55,000 single-family homes go from active listings into contract this week. That's down from 58,000 last week. So this is one data point. But if you were to look for signs that home buyers react to a sharp increase in mortgage rates, this might be one place you'd see it. So if your potential payment jumps big in 1 week, then maybe you hold off and don't make the offer. Remember, this is the opposite of what was happening last February. That was when rates were in the 3s, but quite obviously headed higher. And the buyers at that time knew they had to accelerate their offers. Now maybe you wait. So in this chart, each bar is a week with a total count of single-family homes in contract stage, pending. They were listed for sale. They took offers. They accepted one and are now in that 30 to 60 day window between the offer and the closed transaction.
Now, be curious to see over the next 30 days how many properties fall out of contract if mortgage rates decline, if people locked in, right? That's something a lot of people are floating the rate now, gambling right now. But if things don't go well, and again, you're writing on a contract, if the rate goes to a certain amount, you're out of the contract. And that's why as a seller, you got to be careful, and you've got to make sure that when you're looking at the agreement of sale, that they don't have a rate that, is out of whack. Like if it goes from 6.5 to 6.75, the contract is void. But you don't want that. So you got to be careful as a seller to look at that and make sure you have a realtor take a look at that. I'm letting him get more data here.
A light portion of the bar are those that are newly pending each week. It's hard to see a 6% smaller portion of bar week to week, but that's what we have. This is notable because pendings have been increasing each week so far this year. The total.
And that's not the norm really this time of year. Normally January, February, you've got low, up, weeks of down, weeks of up, until you get into March in the spring market when things normally climb.
Number of homes in contract continues to climb. 306,000 single-family homes are in this pending stage right now. And you can use this chart as a leading indicator of home sales across the country. These sales will close in March and April. At the right end of the chart, you can see steady recovery in the number of home sales that we've had since the very low start of the year. It's spring, so even if this recovery pace slows due to the higher mortgage rates, the total number of homes in contract will keep climbing through June. There's just more transactions that are happening now. Again, this trend now is notable because it's not just seasonal, it's more than seasonal. If you're completed sales for whatever, when we were at the end of the tail end of the pandemic buying frenzy. If a contract fails and a home gets relisted, it comes out of this chart and gets counted back in the active inventory chart. And active inventory is still falling each week.
So active inventory continues to fall. Normally this time of year, it is increasing and increasing pretty quickly. So this curve we have going downward is not normal. Normally this is sloping upward. And if you go to pre-pandemic levels in 2019, pre-pandemic average was 820,000. And we are down to 436,000, basically half of that, just over half of that.
The available inventory of single-family homes for sale in the U.S. fell by 1.5% this week to 436,000. This is a market where sellers are very hard to find. We have some demand and few sellers, so inventory keeps falling. The weekly inventory decline is slowing, though, meaning that supply-demand imbalance is getting a little better as we get into spring. My guess is we probably have 2 more weeks of declining inventory before we see the bottom of the curve for the year. If inventory keeps falling into March, that would be the next surprising development of an already surprising new year in housing. In normal years before the pandemic, inventory would be climbing by this point. So this is why we've been surprised at how resilient the housing market has been so far. I've highlighted 2019 here. The low point of inventory in 2019 was early in January and then again early in February. By late February, inventory had been climbing in 2019 for a few weeks, and there were over 820,000 single-family homes active available on the market for buyers. That's almost twice what we have available today. And so we used to have much more inventory, much more supply, and it would be growing by now. As recently as New Year's this year, I expected this year to behave much more like 2019 than 2022, but I was simply wrong.
Again, this year is going to be an anomaly, just like last year was an anomaly, just like 2021 was an anomaly, and 2020, this whole pandemic-driven market that we are still experiencing. And I don't know how long this will go on, whether it's 2024, 2025. I would suspect it would go into those 2 years of just different behavior in real estate, not normal markets. Typically we're used to the, let's call it October till February being the slowest point of the year, not much activity. Well, it hasn't been the case the last 3 years. It's not gone on its head, but it shifted and changed, and people are seeing maybe this is an opportunity to buy when the market's a little bit slower and there's less buyers out there and less competition. Because once we get in the spring market again, we're going to have a little bit of a frenzy. The question is, will rates cooperate enough to make it a feeding frenzy or not?
So here's how you know this supply crunch is from a dearth of sellers. There were only 55,000 single-family homes newly listed for sale this week. That's 24% fewer than last year at this time, 24% fewer. Last year, we also still had the pandemic bidding wars and immediate sales. So where last year we had not many sellers and huge demand, this year we have even fewer sellers and in just sort of modest demand. In this chart, each bar is the total count of new listings in a given week. The light portion of the bar here are those that went into contract essentially immediately after a listing, what we call the immediate sales. And what you can see is it's remarkable how the sellers shut off after July 4th and have not returned. Homeowners in America are holding on to their ultra cheap mortgages. Like, why sell the best financing deal ever? Even if
Exactly. Because what we have now, your cheap mortgage rate is one of your biggest assets. It's not a liability like we looked at when mortgage rates were 8, 9, 10%. When you have a 3% mortgage, what you can do with that property, you have just exponential returns on it, right? It's a cheaper cost, cheaper place for you to live. One, you can rent this thing and cash flow it like crazy. So you may have people that would initially want to sell, but they're going to be like, I don't want to sell this. This rate's too cheap. I can't afford. You know what? I can rent this thing with what my mortgage payment is and make $500 or $600 a month. Buy another property. Yeah, my mortgage rate's higher, but I could use that $500 or $600 a month to reduce my payment on my new property. And don't think that thought isn't going through people's heads, because it is, because that's where we're heading. And that's where inventory is telling me. And that's what demand is telling me. And lastly, on this point, I thought we had hit the peak of the market last June, July timeframe. We haven't hit the peak of the market yet in the hot markets. In the markets that have been affected, Silicon Valley markets, yeah, they've hit their peak. They're on their decline. But again, real estate is not one big market. It's many different markets. It's all localized. So a lot of markets have not seen their high yet, and understand that even with rates the way they are.
if I'm buying a new home, we could see that like many Americans are not giving up the existing home that has that 2 or 3% mortgage. I think that's what's going on here. We can hypothesize that American homeowners are locked into their ultra cheap mortgages, and we can also see it play out in the data. At the right end of the chart, you can see how few home sellers are coming out each week. We don't yet know how completely the 7% mortgage rates will cut off demand, or quickly, like it did last summer and fall. We have plenty of buyer momentum right now, and we can see that in the price reductions data. Currently, 31.3 of the homes on the market across the US have taken a price cut. This shows dramatic improvements in the relative levels of demand from last fall. See how steep that dark red line is falling here? If last spring and summer was notable by how quickly home sellers were cutting prices, the reverse is true now. So the light red line is a curve from last year. In normal times, about a third of the market, 30 to 35%, take a price cut before they sell. In recent years, it's been lower than that, and March is the point at which fewest price cuts are happening, because that's when all the new inventory is listed, and they don't have to take a price cut until maybe later in Q2 if they haven't sold yet. So in the last 2 years of pandemic craziness, though, 30% thought they were overpriced, but only 15% took price cuts because a lot of them got their offers. We had bidding wars and insatiable demand.
So don't expect that. Don't expect the bidding wars. Don't expect the insatiable demand. I think what we're going to get is a little bit more of a slightly normal market than we've had in the past as far as demand. You're not going to have to worry about waiving a reinspection. You're not going to have to worry about being a cash buyer. You're still going to have to be competitive. You're still going to have to be near that ask price or at ask price or just slightly below. And I can tell you the properties that we're selling, we still get bidding wars. We still get people bidding above in different markets, and other ones we're just getting people getting close to the asking price. And it depends on how much work these properties need too, right? Obviously it needs more work, they're going to pay a bit less, but in general, we're getting around near the asking price. So that's still going around, it's still going on in most markets. That's something that's important.
Then last summer, we could see that abrupt change in demand, and buyers stopped cold. Now we see the inverse happening, and where we can see more homes on the market now that have had price cuts than recent February's, right? There's more now. It's still recovering from last fall. The slope of that curve shows us how quickly that market is returning to normal. So now what happens if rates stay at 7% or go higher. They could go higher because the economy has been reporting such strong growth numbers on almost all fronts. So watch price reductions as a gauge of how quickly demand gets cut off. The dark red line curve here, this curve it'll curve flat and then start rising. But does it get under 30% first? Do we get back into that cluster of recent years? Or does it reverse and head higher like last year if buyers are really sensitive to rates at this level?
And I do think that's going to happen. I don't think it's going to go below those lines. I think it's going to reverse course. It's going to go higher if we get these rates around 7%. If it goes, God forbid, it gets higher than 7% again, you're just going to see demand really tail off. There's still people that want to move and go to different places or change their house, even if it's more locally than it is long distance. But rates are the driver, man. Rates really are the driver. And I think we'll see that as we do this each week. I want to kind of go over what he puts out here in the research, and we'll break it down.
One reason that sellers don't have to cut their prices is that they're starting at more reasonable levels, asking prices. So the median price for single family homes in the US this week is $419,900. That's up just a fraction of a percent from last week. Home prices always climb in February, but this year's slope is very modest. Last year, prices were spiking each week because sellers knew like the buyers demanded it. You could see the trajectory of the dark red line here at the far right is going to peak lower than last year's peak. And that pricing is almost always, that June 30 peak is June 30 is almost always the peak for each year. Yeah. So you can also therefore gauge the future of home sales prices by watching the light red line here. That's the price of the newly listed cohort each week. Of those 55,000 new listings, see how at the right end of the chart, that light red line is going sideways? That's home sellers telling us they know exactly where buyers are buying. At $393,000, the price of the new listings is essentially unchanged from last year at this time, like a year ago. So 0% change from a year ago. So home prices are flat, and in next few weeks, you can even expect it to be lower, prices to be lower than where they were a year ago. And that's why we can pretty confidently say that for the whole year of 2023, prices are at best flat. Even as the supply-demand imbalance exacerbates this spring, demand is at very clear price points. Affordability is an important factor for home buyers, and you can see it playing out right here.
All right, he hit the nail on the head with that one. It is, I think, potentially going to be flat for different markets, right? Not for every single market here. Let me stop the screen share. I think it's going to be flat. Typically, in your typical markets in Northeast, Midwest, it's the desirable areas where people want to be, the Sun Belt, that are going to have those increases, right? You got Alabama, got strong growth. The Carolinas, both of them have strong growth. Tennessee, Texas, Florida, even to an extent, you get a little bit there in Louisiana, a little bit in Mississippi. They don't really fit that Sun Belt area, but Florida still got a ton of demand. I'm still seeing prices. When I look at comps, I'm buying properties down here and I'm fixing them and reselling them. It's escalating. It's not dropping. It's not dropping yet. Doesn't mean it won't happen. If rates get back up to 7% and over 7%, yeah, it'll start dropping. It'll start having an effect. But as of right now, I still think, we're in a spot where rates are going to drive everything. The rates are the driver for the market. The rates are the driver for rentals, because as rates go up, more people will go into rentals, and then rents will increase. And then rates drop. Less demand for rentals, more demand for houses, rents will drop a little bit. So they have that ebb and flow together. It's all rate driven for mortgages, or for rentals, I should say, and also for home buyers. All right, guys, that's the update here. And we will update you in the next couple of days on a couple other things. I'm going to do a deal review this week, potentially tomorrow. if not on Thursday. A couple other deals that we've done, and some that have just closed. One is going to close on Friday. I'll break that one down, show you what the costs were, what the profit was. Again, we just buy bank REOs, so we aren't direct to seller. Everything we do is through our own time and energy, right? That is our marketing cost, our time. We pay nothing for that. We pay nothing for dispositions because, in most part, we list and resell. So, if this is something that matches you and you're interested in learning a little bit more, you can go to www.reoauctionacademy.com, or you can also go to www.fliprealestatevirtually.com. That's fliprealestatevirtually.com. Two of those things, they'll also be in the show notes here. You could do a subscription for as little as $97 a month, getting our monthly coaching calls. And we talk about how to we kind of hold your hand, help you with different things. A lot of Q&A. We bring on different lenders, bring on national insurance companies, national lenders, national title company, all kinds of resources. We'll probably be bringing on a realtor soon, to this bank REO realtor, to talk about what the process is, what they deal with from the asset manager on how they can list their price and what the price expectations are. All right, guys, we will catch you on the next broadcast.